What's going on, guys? I figure we'll do a little live trading breakdown. I'm just going to kind of go through the markets. I'm just going to, talk about what I see, talk about the trades that I did take today, and kind of just market watch for a little bit. So currently 7:43 here in California. Obviously, depending on where you're at in the world, time's going to be a little bit different. Obviously, New York time's going to be closer to that 10:40 hour. So what we're looking at here, NASDAQ 100 down 115 points. Very, very big flush. Okay. So when we kind of looking at the price action and we're looking at this flush here, we want to see a couple of things. What area of demand did we just lose, right? Bollinger Bands were getting extremely tight. Now, again, I know my chart's going to be a little bit difficult for some of you guys to read. That's okay. Just follow along with the price levels that I'm giving you, and you guys can correspond that to however you set up your charts. But I've got the Bollinger Bands pinching in this morning. We're looking at the 1 hour time frame. I've got these linear regression channels. Now, the bottom of this linear regression channel is going back to yesterday's low point here, and it's 18,239. Okay, so once we lost this 18,239, we really started to dump. Now, why did we start to dump? Because we have no support here on the 1 hour time frame. Now, does it mean it has to come all the way back down to this prior swing low? No. But what I'm saying is the price can get very, very sped up, and it can really start to fall very, very quickly. So if you are a day trader, you're a scalper, this is what you're looking for, right? So let me kind of show you how this works out. If you go to your 5-minute time frame, okay, so go to your 5-minute time frame and you look at this low here off this linear regression at that 250 mark, right? 18,250. Look at this low in the overnight. Look at the linear regression. Notice when we break it at 7:30 Pacific Standard Time, so 10:30 New York. As soon as we break it, what you're looking for then to see have happen is a new low get put in, which is here, and a following candle to confirm, okay? So would you have missed out on this big drop? Yes, but I'm going to go ahead and show you guys how you could have jumped this trade a little bit earlier in just a second. Let's just talk about losing the overnight session lows and losing this linear regression. So once you break through price, okay, typically what a lot of new traders do is they go short right away, okay? And what tends to happen, not all the time, but what tends to happen is they get very excited, they oversize themselves, it puts in a quick move and then immediately snaps back. Now, when it snaps back immediately, either you're sized too big to where you get stopped out, or you have to take the loss, and it still continues to go down. So make sure your position sizing is intact first. Another thing, when you take it too early, you're never giving yourself enough time to see if the trade's going to work out. You're always expecting it to work out, right? Because you need it to work out, right? So size down. What you want to see have happen is if this is the level, okay, we need price to break the level, and then we need to put in a new low. Once the new low gets put in, we need to confirm the new low. And once the new low gets confirmed, we don't need to wait for this candle to close. We can just go ahead and take the short position here. So this short position should have been taken at around 10:35 a.m. Okay, so 10:35 New York. We should have been able to take this position short here. Now, this was a 32-point range candle, and the next candle that sets up was a 67-point range candle. More than enough money for you to make money on the downside. Okay, we're talking about from swing low here on this confirmation candle of 18,226 all the way down to 18,171. You're talking about almost 50 points. Okay, so depending on your position size, depending on how many contracts you're playing, is going to be all dependent on where you're going to take your profits. But as we continue to watch this, if you believe in the theory, right? Because there's always has to be a theory. If you believe in the theory that stocks are going to trade from supply to supply and demand to demand, then you're expecting us to get somewhere relatively close to 18,120, 18,150. That would be our linear regression. Now, here's where theory and emotions and thoughts tend to get skewed. Because people will look at this move they would have not taken part in it, meaning you never took the short here, you never took the short here, you're still not taking the short here, and you're coming into the market looking at it thinking, well, we've got to come down here and test this demand. So what happens is you tend to get short here, and maybe it goes down a little bit and then starts to come back and stops you out. You are jumping out of the 10th story building, shorting down here. Now, we want to be mindful that we could in fact come down another 20, 30, 40 points, but the move is already in place. Okay, so the move's already in place. So just look at this area as your final resting spot. If we do kind of get down into this area, maybe look for some consolidation and maybe see if you can catch a little bit of a bounce swing back up to the upside. Now, if we're talking about going long, bulls right now at this point in time where we stand going into almost 11 o'clock New York, we've got a lot of work to do. And I would like to see us get over 18,222. From there, I would treat it as a scalp into 18,250. Okay, so this little bit of a pocket here, anything over that, I would kind of leave alone. You've got resistance here and you've got a shit ton of resistance here. Okay, so your upper resistance is going to be around 18,333. And your mid resistance is around 18,260. So between this range here, I would expect things to be choppy. This would put you right back smack dab in the middle of the range. So if you look at the highs, you look at the lows, where would this put you? Right back in the middle of the range. So I don't like to trade in the middle of the range. I like to either take bounces from the bottom of the range. I like to short the top of the range, or I like the top of the range to be broken, back tested, and then I like to go long. I like the bottom of the range to be broken, back tested, and then go short at the bottom of the range. Hope that helps you guys. I'm just going to quickly look at some charts here. I want to show you guys the Tesla trade that I took this morning. So I was looking at Tesla in the pre-market, and the reason why I was looking at Tesla, let me actually start from the daily. The reason I was looking at Tesla, if we notice Tesla's daily chart here, this is the first day that we closed back over our 20-day moving average on a daily time frame. So if we confirm $174.50, I would be interested in the long. I took 175 strikes and made some really good money. Now, I missed out on a couple of bucks, but someone else's money. What we're looking at here is what I was looking at was to confirm pre-market highs, okay? Confirm pre-market highs. Notice if you guys follow my channel, we also had a 20 SMA play here that would have put you in a little bit earlier. However, I was waiting for pre-market highs to get broken. Once pre-market highs get broken, I want to jump in on the following candle. So I was in on this candle here, pulled back for just a moment in time, never took out the previous low candle, never took out my max pain stop. And once it started to run, it really started to run. And again, going back to the theory, if you believe that once we break an area of supply, that we're going to trade to the next area of supply, then you should be taking profits into 177, because 177.80 is this top linear regression line. Now, this is why I say I missed out on a couple bucks, because I was looking to sell into 177, which is my supply zone. However, it still went up around another $1.50, almost $2 before kind of resting here. Now, on the pullback, we have pulled back into the 20-period moving average. So again, good spot to go long here on a bounce, sure. As long as you're protecting yourself, you would have to use either the 20 SMA as a hard stop or this swing low as a hard stop. Again, if you do decide to get long here and it does close below the 20-period moving average, just take the quick loss, move on with your day, and find the next setup. Now, would you be looking for the short position? Me personally, probably not. Not right here where we stand. What I like to do when I'm looking for mean reversion trades or you know, trades that are going the opposite way is I like to look for big extended moves up or big extended moves down, and then I like to see inverse hammers, okay? Or I like to see hammers coming from the bottom. And when I see those, all I'm looking for is green to take out red. I want to be short. I use the high of day as a stop and I sell for profits when I'm green. I have no price target in mind, because I don't know how far it can go down. Can it come down just to here and bounce? Sure. Can it come to here and bounce? Sure. Can it come here and bounce? Of course. So what I'm looking to do on these particular plays is when green takes out red on a mean reversion trade that was going extended to the long side, I'm setting my stop loss at the high of day. I'm getting in, getting green, and taking profits into demand, into demand, into demand, into demand, into demand, into demand. Okay, that's how it works. I'm not looking for this is the end of the run and we're coming all the way back down here. Now, could Tesla very well sell off? Sure. Tesla has been an absolute dog of a stock this year. It has not been following the market. And, you know, it's been under heavy fire and heavy selling pressure. So, again, take it for what it's worth. I'm a big advocate on identifying patterns that you have seen in the past, okay? Patterns that you are familiar with, patterns that you recognize. And I'm also a big advocate of sizing yourself regardless of the dollar amount that you're going to make per trade, but sizing yourself accordingly to where you can jump in these trades without having to worry about, if I lose this trade, I'm going to give everything back. If I lose this trade, I'm going to blow my account. I'm a big advocate of having a higher win rate percentage, but maybe I make a little bit less money. But guess what? On the flip side, I'm a lot less stressed and I don't have to sit here for 10 hours trading. Now, I'm not going to sit here and say I'm a multi-millionaire and you know, I'm making, you know, hundreds and hundreds and hundreds of thousands of dollars a year trading, but I make over 6 figures trading and I do make a decent living for myself, but I'm treating it more so as a 9 to 5. I live in California. I have a mortgage. I have car payments. I have insurance. I have a son. I've got to eat. I've got hobbies that I want to do. So I know what my cost of living is. I need to make that cost of living and some to live comfortable. Now, I'm not saying that I'm living lavishly, but comfortable. And that's what I'm looking to do. Now, am I sitting here saying that I'm content? Of course not. I'm never content. I always want more. But I always know that the harder I push on the gas trying to make more the harder it becomes. These things have to come naturally, organically, by discipline, patience, and smart business practices, okay? Treat it as a business. Tesla's continuing to come down here. Our next support on Tesla is going to be 174.26, okay? 174.26 is going to be the level on Tesla. I'm going to give a quick look to my Discord here very quickly, so just give me a second, guys. Give me 1 second, guys. So if you really think about it, right, on the grand scheme of things, what do you need to do as a trader? What you need to do as a trader is make sure that you are able to perform every single day, and you have the tools to be able to perform every single day. And some of those tools that you have, right, that you need are going to be tools such as liquidity. You cannot trade if you have no liquidity, okay? So if you have no liquidity, you've got no capital, you're out of the business. And some of the things that are going to put you out of the business a lot quicker is simply trying to rush to the finish line, right? Is what I'm trying to say. And when people rush to the finish line is when they find themselves under a lot of distress, a lot of pressure, because trading and pressure, trading and stress does not do well. Okay, give me 1 second, guys. So just kind of getting back to the point, right? Just kind of getting back to the point. When you are trading, you have to always make sure that your emotions are in check. Okay, emotions are first, right? You're no good to yourself if you don't have the proper mindset to come into trade, right? So a lot of times I'll speak to newer traders, and one of the biggest problems that I see traders having, especially in the beginning, is they're rushing to a finish line that's not there, because the finish line always continues to get moved a little bit farther, right? You make $100, you want to make 200. You make 200, you want to make 500. You make 500, you want to make 1,000. The same rules apply. I can give you guys a quick little backstory here. The person who taught me how to trade, my mentor, almost 9 years ago, 9.5 years ago, 8 years ago, they were trading 1,000 share lots, right? Equities, okay? 1,000 share lots, looking for 50 cents here, 75 cents here, $1 here, right? My account could not afford 100 shares, right? So I couldn't even trade 100 share lot trading with someone who's trading 1,000 share lots. That's why I kind of inched my way into options. So I'll be able to control a little bit more, for every one options contract, you're controlling 100 share lots, so forth and so forth, which is kind of why I've always worked into trading 10 contracts, because I always had it in my mind, right? I wanted to be like him. I wanted to trade 1,000 share lots, right? And the best way that I can control 1,000 share lots, quote unquote, is to trade 10 options contracts. Now, is it completely the same? Of course not. You're dealing with premium, you're dealing with the underlying asset, is two completely different things, but you guys kind of get where I'm going with it. So you cannot ever compare yourself. And one thing that has been detrimental to a lot of traders is fucking social media, because social media, it doesn't matter where you're getting your information from, where you're getting your news from, whether it's YouTube, whether it's Twitter, whether it's StockTwits, whether it's Reddit, whether it's Instagram, it doesn't really matter. Wherever you're consuming, right? Wherever you're consuming your trading content, wherever you're consuming your trading knowledge from, you're always going to get those outliers where this person with this XYZ strategy makes $10,000 a month, or $10,000 a trade, or $10,000 every fucking minute, right? Or this person driving this car, this person trading from the Bahamas, this person doing this shit full time, blah, 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 right? You cannot compare yourself to other people. And the reason why, obviously, you can't compare yourself to other people is because you don't know if the story's ever legit, right? I'm always a big, doubter, right? I want to see something for myself. And it doesn't mean that I need someone to show me what they're doing is correct. I need to see it, right? I need to do it, because it doesn't matter. I could look at 100 traders that all claim to make XYZ cash. It means nothing to me. Is it putting any money in my bank account? No. Is it putting any money into, food on my table? No. I need to do it. So that's great. I need to learn the skill set. I need to learn the emotions. I need to learn the mindset. I need to be able to do it. All it really takes for a trader to break through is to see it a couple of times. As I'm talking, we're getting a nice little, what I call in my room, a little bit of a Biggs bottom, just a mean reversion trade here. We kind of coming down into this linear regression on the NQ. Again, green candle taking out prior red, back over the 5 SMA. It's already midway here. You would have had to have already been looking at this particular trade. However, I just want to point it out, right? So if I go ahead and I mark this out here, what are these mean reversion trades? What are these, in evolution traders, we call them, quote unquote, Biggs bottoms, right? We've got a guy, last name Biggs, in our room. He trades a lot of these type of reversal plays, a lot of these topping plays, a lot of these bottom feeding plays. All you're really looking for is big extended down move, big extended up move. And then you're looking for that reversion. You're looking for that short-term change in trend. And typically it's going to come when you get some type of inverse hammer candle, depending on if the play is long or short, some type of crossbar candle, or some type of bounce off of a supply zone or demand zone, right? So in this particular case, market's been on a nice washout, significant move down, right? So one leg down, and then we're coming into, for example, on a 5-minute time frame, linear regression support at 18,126. Now, before you start thinking, well, we never came down to 18,126, so why would you go long here? We don't have to touch, right? Remember, moving averages, supply zones, demand zones, they're not concrete brick walls. They're used, however, they do touch and test pretty accurately to the T a lot more times than they don't. But what you want to see is something of significance supply demand zone wise, And then you want to see price action. You want to see volume. You want to see something happen, right? So if you were to look at the 5-minute NQ chart now, look at the previous green candle, look at it, take out the previous red candle, and close back over the 5 SMA. So the question would be now, do I wait for that candle to close before getting in? Meaning, do I take my entry on this current candle, 8:03 a.m. Pacific Standard Time at 11:03 New York? Do I take my entry now, or should I have already been in the trade? The answer is you should have already been in the trade. And you should have been in the trade when green takes out red and we're breaking through a 5 SMA. Now, if you don't have the 5 SMA on your chart, you have no idea what the hell I'm talking about or looking at, right? Do I recommend putting the 5 SMA on your chart? It's up to you, right? I mean, again, I've got multiple screens, multiple monitors. Some of my charts, it's just a simple 20 SMA and a 200, and other charts that I have here, I've got all of the moving averages, right? It definitely can get a little claustrophobic when you're looking at a chart with this much bullshit on it, right? But it helps me, right? It helps me, and it's the way I've been trading for years. I'm not going to change it just because, you know, people say that it can be confusing. It has nothing to do with it. Again, remember what I just said 5 minutes ago. I don't care what someone else is doing. I care about what I'm doing. I care about what works for me. So everyone as a trader needs to figure out what the hell works for you, okay? And just kind of getting away from the topic of this setup, I'll talk about it in just a second, but what works for you might not work for me. What works for me might not work for you. Does that mean that any one of us has the right or wrong way to trade? Of course not. Does that mean that everyone needs to try to trade the time frames in the way that I trade? Of course not, right? Inside my room, I have people who trade all different types of setups. We all maybe see the same chart, but maybe we're trading price action a little bit differently. So again, also something when it comes to becoming consistent, becoming a profitable trader is forget about what everyone else is doing, right? Someone's making money, you haven't seen a trade setup. That's fine. That's fine. Maybe you've taken a setup, but you're kind of wondering, how come no one else is seeing the same thing that I have? Other people's reaction times, execution times are different, right? You have to remember, everyone here is a human being. Of course, I hope so. So everyone's going to have a different mindset. Everyone's going to have a different tolerance for risk, risk tolerance level. That's different. Everyone's going to have different emotions, different anxieties, different fears, different FOMOs, different this, right? However, the chart that you're looking at is the same chart that I'm looking at. The chart that I'm looking at is the same chart that Tom, Dick, and Harry are looking at, right? Everyone's looking at the same chart. What it really comes down to is how well do you identify patterns that you've seen before. So for example, when we're talking going back now to this bounce play here, where would my profit taking zone be? It would be right here. Now, am I just saying that because it might come down? No. But if you look at my chart, right, which I'll post this chart up in a minute here, and for those of you guys who are going to be rewatching this video later, you'll see, but this is running right into the next area of supply. And this is the third time that I've said it on this video, is that stocks, if you do believe the theory of technical analysis, stocks are going to trade no matter what, more times than not, from supply to supply and demand to demand. What the hell does that mean? When we confirmed the 5 SMA on the 5-minute time frame on this bounce as it started, if I believe in the theory, then I'm believing that we are going to trade into the next area of supply before we are met with resistance, or we confirm the next area of supply to go to the next area of supply. So between the 5 and the 10 SMA, there's an area of resistance, right? So if I'm going to be actively in this bounce play here, I want to make sure that I'm taking profits into the next area of supply. Now, again, if you don't have your chart set up this way and you're not looking at the 5 and the 10, you don't need all of that. You can go back, right? You can go back prior candlesticks for example, me here in California, 740. So you go to a 1040 New York candle, look at the high wick on that candle, right? If you look at that high wick on that candle, that's going to be a supply zone. If you go over to the next candle, that's going to be another supply zone. So you can definitely make your own trend lines. You can make your own supply and demand zone lines. You can do all of that on your own. You don't need moving averages. So that's why when you have traders that say, well, I don't use this moving average, I don't use this, I draw my own supply and demand, it's all the fucking same, right? Everyone's looking at the same candlesticks. I can wipe this chart clean and I can make my own trend lines, my own price level lines, my own supply and demand zone blocks, and it's going to match up with what you have on your chart, because if price is significant in these areas, it's going to match. The only reason why I will use, and some of you guys have seen me with the chart where it looks like a bunch of fucking shit, it looks like a bunch of spaghetti all over the place. Why I use that chart? Because I'm lazy. I'm not going to sit here and I'm not going to draw out every single supply zone each and every single morning. These things change. I got to take shit off. The next thing you know, I'm trading 2 weeks later and I've got something that I marked on the chart from a month ago and I have no idea or reflection point of where it came from. It's easy for me. I'm very lazy. Been doing this way too long to get up every morning and rechart the chart, right? So that's why I will leave these supply and demand zones on there. So when you're thinking about it, right? When you're thinking about the supply and demand zones, you have to understand that stocks are going to go from supply to supply and demand to demand, right? So on this particular bounce play, on this particular reversion play, now that we've taken out the 5, we've taken out the 10, I'm looking for us to take out or test the linear regression. Again, now what's the difference between a trader taking profits over the 5 into the 10 and waiting for the 10 to into the linear regression? It's the trader's discretion, 100%. The trader's discretion. Again, where you take profits could be different than where I take profits. And what it really boils down to is how much size you have on the table, right? How much size you have on the table. Because someone who's trading heavy size is not going to be sitting all day waiting for these ups and these downs. Someone who is trading small size can afford to sit through these waves, can afford to sit through a little bit of drawdown, allow it to come back down and test support, go back up. So again, you always have to trust technical analysis. Give me 1 second, guys. So again, just to kind of recap, just to recap, in this video, it will get posted. So if anyone wants to go back and rewatch it, you can definitely rewatch it. But how do you know when to start looking for these bounce plays, when to look for reversals? Again, very simple. Extended move down into a level of demand, or an extended move up into a level of supply. And then you're looking for some type of non-continuation of the previous candle. That can be anything, inverse hammer candle, cross candle, whatever you want to call it. Volume starting to dry up, doesn't really matter. Your entry on these plays, and again, this comes with a lot of experience, and it comes from a lot of losing trades, right? Trust me, I've taken these plays before. I identify the pattern, I get in. 2 minutes later, I'm getting stopped out. Well, it didn't work, right? Is it because the strategy sucks? Is it because I don't know what the hell I'm doing? No, it's because I have no control over the price, right? Size myself accordingly. I can withstand the losses. I can withstand, the bumps and bruises. I'm not worried about that. It's on to the next. And that's another thing in trading. It's always on to the next. We cannot put so much emphasis and so much focus into this one particular trade. If we take a trade and you have that feeling where I got to win this trade, you're doing something wrong. Either too much size or putting way too much emotional stress and pressure on yourself. Because what you need to look at is how are you going to finish up this week? How well are you going to manage your assets? How well are you going to manage yourself this week? Are you going to finish green this week? No? Yes? Or how well are you going to manage yourself? Are you going to finish green at the end of the month, the end of the quarter, the end of the year? Are you going to even be able to stay in business until the end of the quarter, until the end of the year, right? So think about that. I always think about it in blocks of 20, right? For me, that's the way I was taught, in blocks of 20. So after 20 trades, assess my performance. What's my P&L? What's my win rate? What could I do better? And then that next block of 20 trades, I try to fix what I've mentally told myself I can get better at. Is it lowering my position size down, going from 1 mini to 5 micros, going from 5 micros to 2 micros? Is it looking at the market environment and conditions right now and telling myself, well, taking profits, waiting for a full one-to-one is not really working. I'll take less profits. Yes, maybe my maybe I'm giving away money is in terms of not holding stocks as long, but my win rate percentage is higher. And if my win rate percentage is higher, that means that I can do what? I can punch out and clock out for the day a lot earlier. Again, it's all dependent on your account size, right? Someone with $100,000 account or, real life funds is going to have a completely different approach to someone who's trading a $500 account, right? There's a completely different approach. So first things first, come to terms with what your account size is, come to terms with what you can stomach and what plays that you can identify, right? It always comes down to when people ask, what's the best strategy? What's the best pattern that you can recognize that you've taken before, right? Because strategies, assholes, opinions, everyone's got one, right? So it really doesn't matter. Each strategy is going to provide a little bit of an edge. Reading the market, reading technical analysis, price action. Sure, you're giving yourself an edge, right? Even by showing up every single day to trade the markets, you are giving yourself an edge automatically off the bat. What becomes difficult is managing those emotions and managing that edge, okay? Again, even your best edge should probably finish just slightly over 50%. Now, again, that's not to say that I don't know traders who only win at a 25-30% win rate. However, those are hyper scalpers, right? High frequency traders who have very, very tight stop losses. So they're constantly getting stopped out, but when they're winners, when they win. Me, I'm not a high frequency trader. I'm not a scalper that's sitting here taking 50, 100, 200, 300 plus trades a day. I'm going to take a handful, okay? Sometimes 1, sometimes 5, sometimes 3, sometimes 8. I'm going to take a handful of trades that I plan on being in between 1 and 10 minutes. Typically between 1 and 10 minutes. So when I need the trade to work, it's got to work, right? Again, just a couple of things just to pass along. Never move stop losses. Never widen your stop loss. Never lose a trade, double your size for the next one. Like, for example, don't do this stupid crap, right? And I've talked to people in the past who do this. Well, market looked good short, so I took the short. However, I got stopped out and I told myself, let me get my money back, go long, double my size. Guess what happens? You get fucking stopped out for more, right? Don't ever do that. That's called chasing the market, right? You're just chasing the dragon at that point in time. You can't identify a pattern or a setup, go short, have it not work out, and flip bias just because it didn't work out. Makes no sense. Makes no sense. You start doing that kind of stuff, you've already lost the game. Because here's what's going to happen in the grand scheme of things. It might work out this time. It might work out next time. And what you're doing is building a bad habit. And when it does not work out will be the time that you're oversized and you've got $800 left of drawdown room on your prop firm or your funded account, and you blow the whole thing and you have to restart everything. Do things the right way and you will be rewarded. Going back to the NQ chart here on this dead cat bounce, again, the low of day would have been your stop. Your first take profit would have been into this 10 SMA. Your second take profit is right here at this linear regression. So again, whether we decide to break through this linear regression and go to the next supply zone, again, remember, supply to supply, supply to supply, demand to demand, demand to demand. So as we keep breaking through these supply zones, you have to take profits or at least respect these areas. Now, I'm not saying that you had to have taken profits at the 10 SMA or even here, but I do want you to understand that if you don't, and this comes back against you and breaks you even, stops you out, or puts you into a loss, it's nobody's fault but yourself that you did not respect technical analysis, right? And again, I've heard this a million times as well. But what if it goes higher? What if I die tomorrow, right? What if I win the lottery tomorrow? You know, what if? We can never live off of what if. It's what is happening. How much do you have on your P&L now? What can you control? Not what if, right? So get out of the what if mentality and get into the what is mentality. What is the active P&L now? Are you green or are you red? That's what you can control. What is your current position sizing? Is it 1 mini contract? Is it 5 micros? Is it 3 micros? What is it? You know, it can't one day be 2 minis and the next day be 2 micros, right? That's too big of a discrepancy. Too big of a discrepancy because you can't control how much you're going to win and how much you're going to lose. And again, there's a lot of people who will be out there that say, well, if you want to risk X percent or want to risk X amount of dollars or X amount of this, X amount of that, sure, you can do that. And I'm a big advocate of trying to align your contract sizing up with what you can stomach. Let me give you an example. Let's say you can stomach a $200 loss per trade, okay? So if I play 2 micro contracts, I can afford to take a trade and put a 50-point stop loss. Yes or no, right? So if I put a 50-point stop loss on 1 micro, it's a $100 loss. If I have 2, it's a $200 loss. Great. If I'm playing 5 micros, it's going to be a $500 loss. So I'm not going to be comfortable with that, right? So I have to adjust my position sizing down to 2. Because the most I want to lose is around $200. Great. Let's say, for example, I take a trade with a 15 point stop loss, and I play 2 micro contracts. Well, I'm going to be looking at a $30 loss per contract. So if I play 2 contracts, the most I'm going to lose is $60, right? Now I can increase my contracts because my range, the stop loss that I'm using is a lot smaller, right? Because for me, the way I trade, I'm a discretionary trader. My trades are very discretionary, meaning sometimes, for example, the first 20 SMA play that set up today for me was a 46-point range. Okay, so do the math on it. 46 points times 1 micro contract, you're going to lose about $90 per 1 micro contract. So if you're playing 2, let's call it $200. But you're looking to make somewhere close to that, right? Again, just because you're risking 46 points, do not become that stiff. Do not become that anal. If I'm risking 46 points, I need to make 46 points. Do not do that. Do not do that. Because what's the problem in taking 3 or 4 micro contracts, giving yourself $200, $300 risk, but taking out 180, taking out 200, calling it a day, coming back tomorrow. Great. No harm, no foul, no stress, right? You got in, you got out before, the market even really got a chance to get going here, right? It's the same thing with the play here down below the linear regression. If we start to look at 735, 730, that short position through those first hour lows, through that overnight session or pre-market session, whatever you want to call it, through the pre-market lows, provided a good opportunity. Now, again, when you're taking these breaks, right, when you take like a first hour low break or you take a pre-market low break, you're always waiting for price to break, put in a new low, and then wait for a following candle to confirm the new low before you get in. When you do that, your stop loss becomes one of 2 places. Previous candle high if you're going short, or a close above the 20. And within that split second, you need to do the math. So for example, if I was going to get in on the 7:30 a.m. Pacific candle time, we close below the linear regression, we start breaking down, I would have looked to get into this play around 7:35 PST. Okay, 7:35. Now my stop loss is going to have to be a previous 5-minute candle high. So if I look at the range that I was willing to give up is 58 points. Most traders can't even fathom or stomach taking a 58-point stop loss. Most traders can't even understand or don't understand that when they enter this trade, you are potentially risking 58 points just to even see it be played out, okay? So think about poker. You have to put chips in the middle of the table to even see the rest of the cards, right? So you basically have to pay to play the game and see what's going to happen with no guarantee that you're going to win, right? That's the beauty of trading. No guarantee you're ever going to win, but you have to put risk on the table to see the outcome. So in this particular situation, let's call it 60 points that you need to at least risk just to see it play out. And why do you need to risk 60 points to see it play out? Because that's the fucking range. There's no way to get around it on a 5-minute time frame, right? Well, can't I get out can't you get out if what? It has to, any candle has to take out a previous candle's high before it shows weakness, before it shows breakdown. That's just technical analysis. So, or it has to take out some type of moving average, 5 SMA, a 10 SMA, a Bollinger Band, something, right? So let's continue with the narrative. If you're willing to take this trade, you're willing to lose 60 points. 60 points, you do the math very quickly and it should become automatic. 1 micro contract at a 60-point loss is $120. 2 is looking at 240. That should be in most people's wheelhouse that are trading prop firms. $200, $100, $250, so forth and so forth. Okay, I can afford to play 2 micro contracts. Great. So that's what I need to take. When I take those 2 micro contracts, I'm looking to at least try to make 50 points, 40 points, 60 points would be great. 30 points. Am I saying that you need to try to squeeze it all the way out? No. But what I'm saying is that if you take profits off early, here's another scenario. Let's say you do get into this particular trade. You understand that the risk was 60 points on this particular flush. You understand if you do lose, you're going to make lose $250. You understand that. The move starts to go in your favor. You take 10 points. Let's say maybe you take one off. You take 15 points, 20. Let's say you sell out of the trade in 20 points. Okay, you took 2 contracts. Let's say you make between 50 and $70, and the price continues to go down. It continues to go down. You cannot take another trade. You cannot continue to take the same trade on the move that you were already in. That's another hard rule. It has to be a hard rule. Whether you took 5 points off this scalp or you took the full 60, you cannot jump back into the same move that you were already in unless you're given a completely entirely new setup. Make sense? So if you don't get that entire new setup, you have to be content with what the market gave you and what you decided to take. Here's another scenario. Let's say you were risking those 60 points. You were okay with it. You're trading 2 micros and you're looking for 50, 60 points to take profits. And let's say it goes down 30 and it comes back. You have to be okay with taking your stop loss in swallowing that pill and not telling yourself, well, I should have taken off 20 points. I should have taken off 30 points. You have to be okay with the decision that you make, the outcome that you make. You also need to have the plan of what you plan on doing. Now, for me, how I do it, again, you can do things different ways. And everyone has their own way to do it. And sometimes I do it this way. Sometimes I do it that way. Sometimes I do what I feel, right? I'm a feel trader. Sometimes I will go heavier size on these particular moves. and I might look to take 7, 8, 9, 10, 11 points. But that might be 150, 200, 250, $300 very, very quickly. And I shut it down. That's it. I'm done. I shut it down. That's it. I'm done. Right? Because if that does go down 20, 30 points, and I think that I'm some rock star, I think that I'm a hero, and it ends up coming back and comes back up to the level of entry and it puts me in drawdown, I'm going to wipe an account. So if I do, it's all about the plan that you have going into the trade. If you are going heavier size, you better get in and hope that it goes green immediately and get the fuck out, right? Get in, get green, and get out quickly. If you're on heavier size, right? If you're pushing the envelope a little bit, if you're playing more conservative and more for the long haul, which I definitely do recommend, 2, 3, 4 micros max. I recommend that because you can stomach those emotions. You can really build an account that way. You can stay in the business a long time that way, and you can make decent gains that way. You would be thinking about, at least half, right? You can even take the ATR. So the ATR at that particular time was 28 points. Great, let's take 28 points. If we're gonna risk 60, let's take 25, 30 points, right? And please, 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 please do not be the person. Well, if I'm risking 60 points and I'm only taking 30, doesn't that mean that if your next trade, you're going to be upside down? Sure. But not every trade is, again, I'm a discretionary trader. Not every trade setup is going to be a 60-point stop loss, right? What if the next trade setup is only a 20-point stop loss? So don't get caught up in those crazy analytics. Let's get caught up in identifying patterns and executing well. Let's get caught up in having a high win rate percentage. Let's get caught up in having high confidence in our ability and skills to read the price and execute on what we know. Let's not worry about, risking 60 to make 30 points. That doesn't sound like a smart idea. It does sound like a smart idea if I can do that 4 days out of the week. It does. It sounds like a damn good idea. If you can come in with a 70, 80% win rate at the end of the week because you're doing that, it is a great idea, right? Versus the next guy who is concerned about risking the 60 points to only make 20 points or 30 points because they're living in fear. They're living in fear of what if. Again, remember what I said. We're not playing the what if business. We're playing the what is. What is the win rate at the end of the week? What is your P&L at the end of the week? Not what if I would have taken that trade. What if it trade loses? Trades are going to lose. There is no ifs, ands, or buts about it. Trades will lose, and you will have those cold spells, those cold streaks. It just happens. It just happens. So on this little bit of a dead cat bounce here, again, anytime you're looking at these dead cat bounces here, like if I was looking at price now, what do I expect here? Big extended move down. I'm looking at maybe, I'm not going to pull out a fib retracement, but maybe this looks like a 25, 30% retracement here. Again, as long as price has not taken out at least 50% of the down move, you have to think about it as this is just a dead cat bounce in wave of the next leg down, right? What would be that next leg down? 18,133. So again, either you caught this dead cat bounce here, aka Big's bottom, aka a mean reversion here off of this lower support, or you're sitting on your hands, right? You're sitting on your hands and you're waiting to go long when. Well, here's my opinion too. Is every 20 play created equally? Of course not, right? So for example, if price gets back over this 20 SMA and sets up, would I want to take that? No. There's no room in this 20 SMA play. Now, does that mean that this, if price confirms over this 20 SMA on this dead cat bounce, does that mean that it can't go up to the highs? Of course not. But what I'm saying is there's not enough room here between 18,258 and 18,280s, 290s. It's going to be a scrappy trade, meaning it might go up, come down, go up, come down. There's too much supply. You have supply between 18,290, which is your 50 EMA, into your 50 SMA at 18,315ish, right? So I would need to see price get back over 18,318 before I even start licking my chops to want to go long, right? Now, does that mean that I want to go short? No. No. I think that the market has provided opportunities within this first 2 hours of being open to have made money. And if we did not make money, I would definitely price watch into tomorrow to get a better feel of levels and where I want to go with my trade direction tomorrow. That's how I feel. Because again, if you just look at price from the market open, you know, we had a little bit of a pop here, was a little bit of a fake out, came back down, 20 SMA play short, consolidation break, broke that 200 SMA. There's another short play that someone could have taken. You treat the 200 SMA as the 20. Again, if you get that breakdown below the 200, get the next candle to follow, you can do it the same way as a 20 play. Or you had the first hour candle lows, right? So if you look at the first hour candle low, next candle opens up, confirms, washes out, so forth and so forth. So I believe that there was opportunities today to make money, right? There was opportunities to make money. And if you're chasing price now and you're waiting for something to set up here, the question is going to arise, what the hell were you doing for the first 2 hours of the market, right? What were you doing? And if the answer is, well, I didn't trust price, or price is choppy. Guys, price is always choppy. Price is always choppy, right? But I like trading when it just goes straight up or straight down. So does everyone. Those days are like, they're anomalies. Like you get those days a few times a month. They're not every single day. The market is choppy 70, 80% of the time. That is the market. There's mutual buyers and sellers on both sides of this playing field here, right? So you have to think about when one side wins, clearly you get those big moves. I'm just breaking everything down in simple terms, right? That when one side wins could be based off of some headline. It could be based off FOMC, CPI, jobs, whatever, right? It doesn't really matter. I'm not a fundamental trader, so I don't really give a shit about the news or numbers or anything like that, because technicals for me always rule. Regardless of what's going on the outside with the fundamentals, it still has to break through a technical level, right? For me to even want to start licking my chops to take the trade. So it doesn't really matter, right? Why do I need to focus on two things? I could barely focus on one. That's the way I look at it, right? So when you start looking at that, you know, if you are a trader who is in this time, it has said to themselves, well, the market's choppy. The market's always choppy. You get one move off the open, you get a consolidation, you get a back test, and then that's pretty much it, right? Or you get a big flush, and then you get a lot of consolidation, chop, 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 and then you get an end of day rally, right? It's the same patterns, right? So it's the same patterns. Get familiar with seeing the patterns. So for example, when the market gaps up, right? And again, I come from the stocks world, stocks and options. So we call gap ups because we don't have this 23-hour trading like we do in futures. But when you get a gap up, generally, you're not going long. It's an unwritten rule. You don't go long into a gap up into supply. That's why I was kind of telling this morning, we're gapping right up into hourly supply. We might get the pop. If you do decide to be a ballsy SOB and go long, make sure you just get in, get green, get out, because you're always going to put in that first initial high and then it's going to pull down. And what the hell that happened? Or you put in the first initial high and it came down. It's not rocket science. This is not nothing that's new. This happens a lot. But what happens with newer traders is they see the market up in pre-market. Especially, you know what used to get me a lot in the pandemic and COVID? Every retail trader would look at the overnight futures. Futures are green today, stocks are going to surge. They jump long off the bell, and the first hour candle slams them. It traps them, goes up, and then slams them, stops and runs everyone out, consolidates, big money, aka smart money, aka hedge funds, aka me. Wait, let them get trapped. You get in on that big's bottom. You get in on that mean reversion. You get in on that 20 play back up to the upside. Ends up taking out the highs and continues higher. That's what the market was doing, just going higher and higher and higher. But you don't chase the first move. You can participate in those first moves, but you better understand that if I take this move, if we get a pop, we're already gapping up and we do get the pop, and I take that move, I better get in and get green, because if I don't, there's a trap coming and I don't want to be a part of it, right? It's the same thing. Market gaps down. The last thing you want to do is, shoot into the hole. You don't want to take part of the short position right off the gates. You want to let it flush. You want them to get trapped, and then you want it to bounce. And if it gets rejected and then comes down through the lows, that's your short position. So it's all about getting comfortable with identifying those patterns and stuff like that. But again, also another not unwritten rule, but it's a rule for me, is I generally tend to stay out of the lunch hour trading. So again, between 9 and 10 a.m. here in California, I don't really like to trade. I might look for a move coming out of lunchtime. Again, it's rare, but you do get those moves coming out of lunchtime, continuation of whatever was already going on. So that could be selling, or you get the reversal. That was the low of day and we consolidated during the lunch hour, which you can kind of see, look at what we've been doing leading into lunch. And then you get that big pop coming out of lunch, right? So there might be opportunities there. Again, it just depends on the style of trader that you are and what you're exactly looking for. But again, it's the main thing is being in control. Just make sure you're in control. You're always in control. The price, the stock, the market does not control you, right? It does not control you. The setups, they're a dime a dozen, right? They're a dime a dozen. Do they sometimes work more so than not? Sure. Right. And you might catch, for example, I'll just use one of the setups that I trade, the 20 SMA. You might catch, 5 winners in a row, and that next one immediately after you get in just goes the other way. Right. It's like, what gives? It's just the way it is, right? It's just the way it is. Make sure that you're sized correctly to withstand that. The only other thing is that when you do take that first loss or 2 losses in a row, or you go down red into the negative, you have to really bite down on the bullet and walk away, right? Because it's like this. Take a moment and think about all the days that you have traded, right? Think about the time that you have put into the market. Have you ever seen a day where the market does not give you at least one setup, right? No. I can go back each and every single day. Now, again, are some setups better than others? Sure. Some setups great and others shitty? Sure. But the point is, every day the market will provide an opportunity. Guys, if it didn't, there would be no market. Think about this. If you had a market where hedge funds, banks, big retail traders, institutional traders, prop firms, real prop firms, now I'm not talking about the stuff that we play around with here, real prop firms, if they had no way to make money each and every single day, would they be in business? Could you survive where you're not given an opportunity? Now, I'm not saying you're going to make money every day, but if you're not given the opportunity to make money, can you go 3 months, 6 months without being given an opportunity to make money? Imagine showing up to work every day, your normal 9 to 5, and you have to work there for 6 months and you're not even given the opportunity to collect a paycheck. How long can you do that for? How long can you survive? Probably not a long time, right? So the point that I'm making is that when you do deal with those red days and you deal with those losing trades, relax. It's not the end of the world. You're going to wake up tomorrow. You're going to be given another opportunity to A, make it back, and B, make more money. So it's only internal thoughts that are leading you to believe that you have to get it back today. You don't want to finish this day red. Why? What does it matter if you finish today red? The next opportunity is knocking tomorrow, and the next day, and the next day, and the next day. So with that, I'm going to end this video here. Again, I want to be around Discord for any of you guys that did chime in. And this video will be uploaded to YouTube. You guys can always go back and watch it. kind of got off onto, you know, a little bit more ranting towards the end versus the price action. But again, it's a lot of things that needs to be instilled into traders. It's like the more you go over rules, the more you go over what to do, what not to do, how to approach the market, the more easier it becomes, right? Because again, price is price. Chart patterns are chart patterns. Strategies are strategies. They're very, very easy to learn. They're very, very easy to learn. It's learning how to navigate the emotions of a trader is a lot harder, and that's what needs to be more emphasized in the stress levels and tolerance levels and so forth. But anyways, with that, guys, I'll be in Discord. This video will be on YouTube. If you have any questions, comments, or concerns, make sure to leave a comment. Also, like, comment, subscribe, and I'll catch you guys all later.